Hi everyone, welcome to the Property Finance Podcast, and today I'm joined by Uliana, who is a development finance specialist, an award-winning development finance specialist, whose previous roles include Deputy Managing Director of the Development Finance Division at Hampshire Trust Bank, as well as Head of Light Development at Octopus Real Estate as well. So Uliana, thank you so much for joining us today. We're going to talk about a lot, I think, over these episodes. So first of all, just give us a really quick intro of yourself, previous roles, etc., and let the audience know who you are.
Thank you very much for having me, Michael. I'm happy to be here. My name is Uliana Kuzmis. I think many of you probably do know me from LinkedIn and from working with me in my previous roles at Mizrahi Tfahot Bank, Octopus Real Estate, and Hampshire Trust Bank. At Hampshire Trust, I was Deputy Managing Director, Development Finance Division, and I assisted and worked with Alex Upton in setting the whole operation in the last 2 years and pretty much taking us to the award-winning place, winning 2 consecutive awards as Best Development Finance Provider in the industry. And previously to that, Octopus Real Estate, I was Head of Development Light, which means full responsibility for all development finance facilities up to 5 million, creating a new process, which I'm very proud of, that allowed developers to get development finance as fast as possible. We kind of made a wrong assumption that smaller loans needs to go faster. In reality, they take as much work as everything else, but we work really hard to make this happen and learned a lot in the process. And I hope all of you, or some of you that have worked with me, Michael including, did feel the difference and did enjoy the journey. So happy to be here.
Amazing. And what a hell of a CV. So what we're going to do in these, what I imagine are probably going to be 2 or 3 episodes, is we're going to try and touch on, well, we've got quite a few questions we want to go through, but we're going to touch on some stuff for both brokers and also developers as well. So we're going to kind of aim this a bit at everyone, which is quite nice. We haven't really done anything like this before. So in terms of, I'm going to start with the first question, and we are just going to hammer through every question one by one and see where we end up. So the first one is, when it comes to brokers, what do they need to know about the monitoring surveyor's initial report? So it's something that, from a developer's perspective, all they see is this invoice, normally for £1,500, £2,000, whatever it may be. But realistically, what do they need to know about that monitoring surveyor's initial report? What's that actually doing?
The initial monitoring survey report is actually one of the probably most misunderstood documents in the development finance journey. And there are a few things developers and brokers need to know. And do tell me if you already know that. The timing. If you instruct the initial monitoring survey report too early, then it won't have much in it. Initial monitoring survey report is quite a comprehensive document summarizing everything related to your project, to your development, to your construction, your PI insurance, your professional team, the details of the professional team, the experience of the team. So if you haven't tendered your project just yet and you don't have clarity around the construction cost, then there is very little value in the initial monitoring survey report. And they cost a lot of money. They could cost anything from £4,000 and all the way to £20,000, depending on the size of the project.
Yeah.
So in some circumstances, a feasibility report is more suitable than initial monitoring survey report. And so many people don't understand the difference between the two and just instruct monitoring survey report, the initial one, pay lots of money for it, and it comes back with nothing in it because the client is not ready yet.
Yeah. So in terms of, we'll touch on the feasibility report in just a second, but the monitoring surveyor's initial report that they go out and is normally instructed either at the same time or after the valuation. As a lender, what are you looking for in that report other than making sure the build costs match up with what the client has said? Is there anything specific in there that you are straight away, right, I need to look for that?
So yes, the first thing you tend to do, and it's quite long report, so the body of the report itself is 30, 40 pages, and then you have potentially 200 pages of attachments, all sorts of surveys and planning and drawings and all sorts of documents attached to it. But the first thing you tend to do, you check the construction cost. And the construction costs would be broken down to the borrower's initial assessment, the borrower's idea of the cost, or the borrower's proposal for the cost. And then you will have the monitoring surveyor's recommendation for the cost and the final element would be the difference between the two. And that difference is crucial because the moment monitoring surveyor uplifts the proposed budget or recommended budget, most lenders will have to take that budget as development tranche into the calculations. And the moment you uplift development tranche, it immediately affects your land loan. So if you had your approval in principle at a certain level and your land loan was at X, and you went ahead and you purchased the site or agreed to purchase the site, relying on this land loan, the moment the monitoring survey comes back and the costs are higher, your land loan drops.
Automatically comes off that,
here is a gap that needs to be plugged, and it needs to be plugged by the developer. And if developer has got deep pockets, fantastic, open a savings account, break the bonds, release the shares and use that to complete the purchase. If they don't have deep pocket and that gap is glaring at them, and now suddenly they're unable to complete the purchase, now the game changes immediately. As a broker, you suddenly running around looking for mess providers. Now, luckily, there's plenty of them, but equally, it's another element, another layer that you have to deal with.
It's another element of the stack, if you like, that hasn't been accounted for, that then all of a sudden there's an extra cost and everything else. But in terms of that gap that's created, so obviously we see monitoring surveyor reports almost on a daily basis. And is it fair to say that really the main contributing factors are, for example, if you've got a developer who is acting as the main contractor themselves, and then all of a sudden there's a QS report that comes back or a monitoring surveyor report that comes back and says, well, actually, you as a self-delivering developer, it's going to cost this, but actually the lenders don't care about that. They care about what it's going to cost if you go bust and they've got to bring someone else in. Then all of a sudden you've got another main contractor. What's it going to cost for someone to actually go out and get that main contractor? And normally it's 15% increase, isn't
Even
it?
more.
So that's probably one of them. And then I think the other one is probably contingency. And the fact that most developers go into a development now thinking that they can get away with 5% probably on new build development, which we know it needs to be minimum 10, if not in some cases 15%. And then I think the third one, which is one that we see come up quite a lot, is where a developer thinks they can develop a project in 18 months, for example. QS comes back and says, well, actually, no, you need 21 months to deliver it or something like that. All of a sudden there's another 3 months worth of interest, etc., which again creates a gap. So I think is it probably fair to say they're the three main things that you're looking at?
You have honestly, you have an excellent knowledge of the topic. The few things here to pick up on. First, if it's self-built, yes, you would expect the developer to build it cheaper than the market.
Yeah,
it is unfair to start adding the 15 or maybe even 20% on top of those costs, thinking about, well, if the lenders had to step in, that's how much it's going to cost them to build. The reality is, if lender had to step in and build the project out, it won't cost the lender 15% extra. It will cost the lender 35% extra.
because it's going to be a rush job.
Precisely. It's going to be alternative contractor. It's going to be stepping into existing job. There's a premium to be paid. We can't start penalizing borrowers for scenarios where lenders will need to step in.
Yeah.
That is why lenders don't go above 65 or 70% loan to GDV, because they keep that buffer in case it's built in. So the reality is the monitoring surveyor's job is to tell us, the lenders, how much it's going to cost this contractor to build it. Not the market, not the BCIS indexes. The laziest reports I have seen, and the ones that infuriate me, and it's difficult to infuriate me, is when you pay to the monitoring surveyor to conduct full investigation around the construction and the budget and the team, and they come back and they say, oh, the median of BCX is X, and that's why multiplied by the square footage of the project, this is how much it's going to cost.
Yeah.
But that's not what we're paying the monitoring surveyor to do.
You need it to be far more detailed.
We need to know what this particular developer can build it for. And it may be cheaper than BCX because it's self-built, and we need to respect that. There's an element here that we rely and we trust this borrower to build it for that much. So that's spot on.
Yeah.
With contingency, even if the borrower puts, my favorite is 2.5% contingency. So even if the borrower put 2.5% contingency, when you put the deal into the lender, I would expect at the initial term stage for this contingency to be uplifted already.
Yeah.
So we're not misrepresenting, we're not selling you the dream. The lender should uplift this contingency to the contingency acceptable to them on day one. And final on term, that was a good point you made. what tends to happen is we take the term that the borrower provides to us, and we check whether it falls within BSIX database. And if it says, if it falls within, say, 90% of the cases, complete project of this time, within this time frame, that is deemed acceptable. So, and also we tend to know how long things take, like projects of similar nature. We tend to have a good feel of.
And I think clients forget that as well, don't they? And also brokers as well. I think there's this naivety that brokers and developers know best to a certain degree, when in fact, actually, 9 times out of 10, development finance lenders are boots on the ground 90% of the time. They've seen everything that can go wrong. They've seen however many cycles. They've seen however many developers go through projects. I mean, you see X number of projects, we see Y number of projects, but yours far outstrips the number that we see. And I think there is that naivety of brokers sometimes thinking that they do know better than lenders, which, don't get me wrong, in some cases they do, but it's very, very, very rare. And I think what you mentioned there about term and everything else, I think sometimes there has to be a bit more reliance on brokers to kind of take that lead from lenders as well, I think, and be able to translate it back to the client as well, because I think it's a massive shortfall of a few people that I've seen.
Very much so. It's one of the previous places I worked at, Octopus Real Estate. I had a mandate up to 5 million. I had hundreds of transactions passing through me for approval as a mandate holder. Hundreds. So over a period of several months, I think we tried to count how many transactions I approved. I think we were about 900 transactions, and then we stopped counting.
It's incredible.
So we do see a lot more than the broker will see.
Yeah, absolutely.
Definitely a lot more than the borrower will see. But hopefully we're getting it right and kind of guiding the client and the broker into a place where the structure of the deal is reasonable and it's workable for both sides.
So coming on to the feasibility report. So for us, this is a big one because it's actually something that we've recently partnered up with a QS to actually offer to our clients, is this feasibility report, because we found there was a bit of a gap in the market, which I think from what you're saying, there does seem to be, which is a lot of developers go into developments with back of fact packet calculations or a spreadsheet with £1 a square foot or £1 a square metre price times by their square foot, square meterage to come up with this average build cost. But actually what this feasibility report is doing, more importantly than anything else, is probably saving the developer, the broker, the lender, time, cost, everything else. Because actually what it's doing is allowing very, very early on for you to see what the build costs are probably going to come back at. And I think that's probably what you were touching on earlier. So in your opinion, are they worth the money? And probably when is the best time to actually go and get a feasibility report?
That's a good question. The timing is more important in this situation. Many development finance transactions are coming to the lender too early in the process.
Yeah.
And they're coming too early for a good reason, because the borrower wants to know that they have funding available and they have backing and they want to pass the underwriting stage, etc.
Well, so, no doubt got a vendor as well who's putting pressure on them, and estate agents and everything else, aren't they?
Precisely. And if you look at averages, it takes about, ideally you want to complete a transaction in 3 months, right? And you can complete in 3 months, but they often take 6 to 9 months to complete. So at the early days, there's no point in going for initial monitoring surveyor because the information is not there yet.
Yeah.
Initial monitoring surveyor has got everything in it. And if the information is not there, all they're going to do, they're going to charge you full fee for it, but they're going to say, oh, this is not available yet, or this process hasn't started yet, or the professional team is not appointed yet, the tenders are not there yet, we don't have any information about your insurances. Oh yeah, we do have full information about planning. Oh, thanks for that. I can get the information about planning myself. So what the feasibility does, it costs a fraction, £1,000, £2,000 max. It's a couple of pages, and it's an assessment of the package that's available at this stage, at early stage, and a gut feel around how much it might cost and what would the recommendation be. The one element we didn't touch on the initial monitoring survey is actually one of the reasons for the uplift in the final initial monitoring survey report is the fact that some development appraisals coming from the borrowers are missing essential
key information.
Pieces. The most
parts of professional fees. Or,
yes.
building
new build warranties,
or
yes, spot on.
replacement warranties at the same time.
Spot on.
It's all that
It's
always
like
comes up.
every single one of them is new build warranties,
Yeah.
and half of them don't budget for new build warranty. Even if you don't know how much it's going to cost, even if you haven't got the quote, well, you put your 30, 40,000 pound buffer there because you know it's going to come. So the feasibility report helps to just iron all of these bits and pieces out.
Things like roads as well, isn't it? I mean, the amount of appraisals that we see, and there's no allowance for roadways whatsoever, and people don't seem to, or developers don't seem to grasp that actually if you're creating an adoptable roadway, you've got to get it to a certain standard whereby it can be adopted. If you're creating an unadopted highway, then fine, okay, you can have it to a certain standard because obviously you're going to maintain it moving forward yourself. But again, it's that risk of, well, actually, are you going to be around to maintain it for another 20, 30, 40 years or whatever you need to be? And the cost difference is huge. I mean, on a deal that we're working on, I mean, it's insane. I think £80 a square foot, I think it is, for an unadopted roadway. It's done in square meters, I think. But anyway, it worked out about £80 a square foot, I'm sure. And then for an adopted one, it was coming out near 150. It's a huge difference between the two. And I'll have to check those numbers specifically later. But in terms of numbers, the difference is massive. So you mentioned tendering earlier, and it kind of brings on an interesting point around the IMS. So with this new relationship we've got with the IMS doing the feasibility reports, they're actually, because they're working for the client rather than lender, they're then able to assist with sort of the tendering process and everything else as well. And it also raises a good point around all these different acronyms that we get in terminology, IMS, PMS, everything else. So let's touch on that really quickly.
Oh, totally. This is so unhelpful to the community. So you mentioned the IMS is working for the client, and the IMS is an independent monitoring surveyor.
Yeah.
But the monitoring surveyor acting for the lender is also called independent monitoring surveyor. They also called QS, a quantity surveyor, and sometimes they're called PMS, which is a project monitoring surveyor, and sometimes they're called MS, which is a monitoring surveyor, and sometimes they're called PM, project monitor. All of those, when the lender refers to them, and hopefully they also add the word lender's PMS or lender's QS or lender's MS. If it's lender's MS, this is the person that reports to the lender only.
Yeah.
They will not assist the borrower with tendering or anything else.
Well, the tendering should be done by that point, shouldn't it, realistically? Although we know that sometimes it's not.
Quite often it isn't actually. And if it isn't done, feasibility is sometimes a better way forward, and it's a cheaper way forward. Because if you do the initial report too early and you pay for it, and then 6 months later, once you have done your tendering, once you have appointed your team,
it all again anyway,
they got to redo the whole thing.
Yeah.
Exactly. And they won't do it for free. They will want to be paid again. So you're effectively paying for this twice.
This brings up a really, really controversial point. And it's when you said they have to pay for it again, it just reminded me of this. And this isn't on our list of questions, but I have to bring this up. Readdressing of reports.
Yes.
I hate it. I can't stand it. And this goes for valuers and QSs. There seems to be an acceptance within the finance world that a QS or a valuer, just for changing the name, and I appreciate that a lot of QSs and valuers that listen to this will say, oh, well, it's actually more than just changing the name. But as far as we're aware, it's just a changing of the name, can charge hundreds, if not thousands of pounds for changing a name.
Yes.
Delicately, what is your viewpoint on this? Because I know you have to be a bit careful from a development lender perspective, what you say here. But yeah, what's your view on that? Because I know it winds my clients up.
I can imagine this. What they're supposed to do is not just change the name, albeit they often just change the name, but they are supposed to readdress the report, readdress the duty of care, and also they're supposed to comply with letter of engagement or instruction letter of that new lender.
And it's essentially moving the insurance across, isn't it?
It is moving the insurance across as well. Now, big question to insurers, if the valuation report is no longer relied upon by the previous lender, it's only relied by the new lender, what do they care? But apparently they do. And going back to the instruction letters are different from lender to lender. So those professionals really should be rewriting the report or tweaking and adjusting the report
Yeah.
in line with the new lender's instructions. If they do that, then a few £100 is probably a reasonable fee to charge. If they don't, and they literally just change the name, it's a little bit cheeky.
Yeah. Which is where I think the QS side especially, I think, comes in a little bit more because, yeah, there are some reports I've seen where literally only the name has changed and it's £1,000 to change the name. And it does seem
Well, I'd make them
excessive.
rework the report as well, because if the time has passed, especially with the initial monitoring survey reports, even if 2-3 months have passed since the original
There's got
report,
to be another look over it.
so many things change because the client would be working on the construction package within this time frame. They may have appointed professionals, they may have got some insurances in place, they may have finalized specifications, or they may have got detailed designs. There's lots of things that can happen in 2-3 months. I would get them to rework the report for the money.
Well, and we've seen over the last 2 to 3 years as well with everything that's happened with COVID, Ukraine war, obviously everything that's now happening in the Middle East, etc. There's so many different things can happen. I mean, in the space of 2 to 3 months, it's
a moving target.
Ridiculous.
It's a moving target, yes.
So yeah, I think you're absolutely spot on. They should be redoing that. So with that in mind, how quickly the markets are changing, X, Y, Z, what is your biggest bit of advice that you would give to developers at the moment with everything that's going on? Yeah, what's your one, I'm going to limit it to one, your one biggest bit of advice that you'd give to, this is for clients at the moment, I'll ask you on brokers separately, but for a developer.
People ask this question all the time, and I have had a chance to reflect on this. If there was one thing I would advise developers to do, there is only one thing they can really do to help themselves. And please don't laugh. It's get yourself a broker that knows what they're doing.
I'm not going to laugh at that. I'm going to second that.
You're going to cry. There's a lot more to it. It's not the one thing. There's so much to it. There's so many moving parts to it.
Yeah.
And the good broker is the one person you need by your side. Developers can never know it all. They can never know all the legal bit. They can never know all the financial bits. They can never be planning specialist, construction specialist, legislation specialist. They can never do that. To a degree, an excellent broker with plenty of years of experience. That's all you need, and they will fight your wars for you.
And for brokers?
For brokers, I would say educate yourself. Understand the process of each lender you're working with. It's the foundations of development finance are all the same, but every lender seems to have its own unique way of slicing and dicing the turkey.
They really do, yeah.
So for the broker to understand how this particular lender is doing it, to make sure they stay on top of things, they stay on top of the problems, they almost foresee the problems, that is key. And understand the fabrics, understand what you're doing. And you would say, well, it's easy to say, how do you do that? There's no written material about development finance. How do we do development finance? Nobody knows.
Yeah.
Those podcasts are gold. Go find pieces of information. Even, I'm sorry to say it, a stupid place like TikTok. There's so many professionals recording themselves, sharing the knowledge on TikTok. I did not expect that.
No, well, I'm on TikTok as well.
You are? Well, recently I am on as well. And apparently TikTok is not all of this dancing and singing silly things. It's what you
very
can...
business orientated.
It is.
I've noticed that as well.
If you choose to have it business, whatever TikTok gives you what you ask for it. If you're searching for silly dancing, you'll get silly dancing. If you search for development finance content, you will get development finance content. And people share. It's a snippets of information people share, and you just absorb it and you take it with you.
So just touching on the education bit. So obviously recently there's obviously been the new course released around specialist finance. However, it does seem, and I may be speaking out of turn, having been involved in actually setting up that as part of FIBA. But realistically, does there need to be something more for development finance? Because in my opinion, I think there should be, because everyone always talks about bridging finance being the most dangerous product that you can be on because of its short-term, high penalty fees, defaults, etc. But actually, I think personally, development finance has the potential to be worse, because if you're a developer who is on the wrong product, it's not only your life that you're messing with, it's lenders, contractors, subcontractors, QSs, architects. There are so many more professionals involved. And personally, I think there needs to be more education for development brokers to get in with the right lenders, because all too often I see residential brokers who specialize in personal houses or small buy-to-lets, etc., moving into development finance, taking on development finance clients, and then putting them with bridging lenders who are masquerading as development finance lenders, who are doing 75% loan to value day one, and then are continuing 75% as you uplift the property. But we know from our personal experience that development finance, there isn't that uplift in value for a long time, because you're digging into the ground, or if you're doing a refurb, you're stripping out, you're reducing the value first. And I think there's too many brokers, I think, going with the wrong lenders. And I think there has to be a duty of care from those lenders as well to operate in the right way, I think. But from your side of things, and from what you're seeing at the minute and kind of the role that you're playing, you're obviously speaking to a lot of brokers, you're speaking to a lot of lenders. What do you kind of see from an education point moving forward?
That's a really good point. And I have been thinking about this recently, that we, in an industry, we don't have a framework related to development finance, almost like not a framework, but almost like guidances, good practices.
Yeah.
What do we do in this situation? What's acceptable here? What's the right way to structure a transaction? And as a result, we have 50, 60, 70 development finance lenders who do what they think is right, or what they have always done, or what somebody told them to do, or what they learned from the previous place. And they keep building on it, almost operating in silo, thinking, oh, this is the way to do it. But in reality, there's better ways to do it. There's better ways to structure it. And it will help brokers and developers if everyone operated within the same framework. You can have your variances, you can have different loan to values, loan to GDVs, loan to costs, etc. But the framework itself, the understanding, even the terminology, how valuable would it be to have the same terminology across the industry? Going back to IMSs, PMSs, right?
So much easier.
Going back to, you may have seen my latest LinkedIn post around what do you call credit-backed terms? Is a decision in principle, approval in principle, head of terms, term sheet, anything else? And there's so many voted on the poll.
Yeah.
And the difference in opinions is vast. Nobody actually knows what is genuinely credit-backed terms.
Yeah.
What has been credit-backed or not. And it doesn't help people to get a document from a lender thinking, what does it actually mean? Has it been presented to credit? Or
has it just gone through the sales team?
Or has it just gone through the sales team? Can I rely on this? But, and etc. So 100% an educational piece of framework, a code of good practices would be massively helpful in the industry for everyone to, even to have access to. You don't have to comply, but if you are complying, it will help your job much easier, because then you know, oh, I understand what it means. So I know what stage that this application is at, because everyone else is operating in the same way.
Well, it saves embarrassment as well, because the amount of times where you'll get something from one lender and you think, oh, great, okay, because I've had something similar off this lender, this must mean the same. I must be at credit-backed terms. And then all of a sudden you get to the next stage and you go, oh, were they not credit-backed terms? Well, it gets very embarrassing to have to go back to clients and explain that the process isn't the same for every single lender.
Precisely.
And likewise as well, one of the things that kind of brings this in nicely is when a lender can draw down funds as well. Because we found it where, for example, if take HDB as an example, in terms of them drawing funds, they don't have to go and get necessarily approval from a funding line over the entire pack again to go and get it drawn down. Whereas there are lenders who will literally take you through the entire process, valuation, quantity surveyor. They'll take you through all of the legals. You'll get to all of the legals being done. Report on title will come in, and they take those 3 reports. They then go to their funding line, and then they say, right, funding line, are you happy for us to now draw down on this loan? Can we have the money? And the funding line are well within their rights to turn around and say no.
No, we don't like it.
And at that point, you've gone 3-6 months down the line, and you get to the end of it, and you go, okay, what do we do now? Because if that funding line rejects it, is there another one that can come in? And I think that there is no transparency from lenders who operate in that way, that they operate in that way. And I think that brings the education point and the framework in perfectly.
The truth is, it's not a secret. So to a degree, you almost, as a broker, you expect to have a little black book where you write down the process for each lender you work with.
We've got a spreadsheet, yeah.
And it's a little spreadsheet, a little secret treasured document which says, oh, those guys go to the funding line late in the process. And that is the riskiest place to be. You don't want that. You want somebody with really established appetite that doesn't change from day to day.
Yeah.
And you also want, go on.
We have them color coded, green, yellow, and red.
Don't go to
red
those
are
ones,
lenders who we will literally only go to if nobody else will touch it. If we've got the most creative deal we can possibly think of, that's when we'll go to
Oh
the
my God,
lenders in
I would
red.
love to see that book. Can I see that? Can I see that
You can
spreadsheet?
absolutely see it.
I would love that. Okay.
But there
We're
are
doing that.
so many in green who have a really nice process, like, for example, Octopus, HDB in green, because they have a really nice process. Everything is transparent. Everything is there. You know what you're getting from day one. Yellow are those who possibly make odd decisions is probably the best way of putting it. Lenders who, for example, we've got into underwriting and then all of a sudden the underwriter is asking bizarre questions. So let's think of an example. So we've got one at the moment where the underwriter has asked for, because the exit is refinanced, they've asked for a set of terms from a lender to prove that a refinance is possible. We've provided it, no problem at all. I would like to see a second set. Okay, this is a development that's going to take 18 months. The whole market is going to change in that 18 months. How can we be sort of obtaining these terms? Get a second set, send it over. You've not used the rental income because it's a service accommodation one. You've not used the AST income, right? Okay, well, it's not going to be on an AST. It's going to be holiday let. We've got 2 offers of holiday let there for you. Go back, get an AST one. And then all of a sudden it's, well, they won't allow a refinance within 6 months. So then you're back again. It's just those lenders going yellow. They are the ones of, if you want a process to take 3 months longer than it should, you go to the lenders who are in yellow.
One. Yes.
But they do deliver, albeit slower. And that's how we've
and painfully
color coded ours. So yeah, that's how we've found ours at the moment. And but I think there's got to be that education around those processes and the framework of development finance.
Let's just touch on process here. That could be helpful. The certainty that the funding line or credit committee will support your deal comes from early exposure to the decision makers or mandate holders.
Yeah.
So a good process would include an early presentation to credit before your client spends time and money on professional reports. You can call it initial credit approval, you can call it initial credit backing, but some sort of paper or submission to credit or funding lines before you spend any time and money.
Yeah.
Right?
Absolutely.
And once you get that support, at least you get all of those wrinkles out of the way in terms of the asset class, the quality of the borrower, the market's supply demand, etc., and location and stuff. So once you have that, then you go and pay for valuation, monitoring surveyor, and solicitors, assuming those reports come back as expected, which they never do. We'll get to that. They never do, but broadly, as long as they come back as presented originally, you have no reason to think, well, why would it be declined later?
Yeah.
Of course, there's always surprises in the process. We can go into surprises later, but of course, there's surprises in the process. As long as they're not significant, you would hope the second presentation will go smoothly as well. And often they do. But as you mentioned, people or lenders that present to the funder or to committee late in the process for the first time, that's a huge risk for you to take.
Massive risk. Yeah. And
100%.
It never reflects badly on the lender either. That's the problem, is from a client's perspective or from a developer's perspective, they blame the broker. They don't blame the lender, they blame the broker. And
you should have known. Yeah, the broker should have known. That's the quality of the broker. The broker should have known the process. That's why you take note of the process.
That's why you've got that spreadsheet. Yeah.
Precisely.
And I think where it can be difficult, though, I think is where, and this is defending brokers to a certain degree, but I think when you use a lender for the first time, that's when it can be tricky, is because you end up with a process that you're not aware of or anything else. And that's where the transparency from lenders needs to come in that if you are using a lender for the first time, explain the process, explain that it's not going to be presented to credit until everything's back, etc. I think there's also many times you speak to a BDM, for example, who is possibly overselling the process.
A little bit, yes.
And yeah, you will deal with a lender for the first time and you'll be sold this dream that it's going to be super quick, super fast, everything will be okay. And that's when the wrinkles start to appear. Speaking of wrinkles, then, so we'll touch on our first potential issue that could come up throughout. So, in terms of getting development finance for a contaminated site, that's something that could come up either at valuation stage or QS stage, or it's very unlikely to be declared early on. I tend to find it does tend to come out either in the QS report or the valuation report. So whether it's asbestos, whether it's Japanese knotweed. So when you've got these contaminated elements on site, what's the first go-to for a lender?
The simple answer is if you are aware of those issues, disclose them.
Yeah.
And the reason for that is they will come out later on, whether it's in evaluation or monitoring survey, or even an environmental report, as you mentioned, but they will come out later when the client has already paid for the professional reports. Some lenders have very strict appetite when it comes to contaminated sites. Asbestos, it's easy. Let's put it aside, because asbestos, all you need, if you found asbestos, you bring professional team that wears protective gear, they remove it safely, and they give you and they dispose it safely.
You just build that quote, presumably, into development finance.
You build the quote, you build the time, it doesn't take long. They remove it safely, they dispose it safely, they give you a certificate, it's clear. The most important thing is not to demolish buildings with asbestos without clearing it first, and then bringing your lenders, including pregnant lenders, on site for a site visit. It happened before.
That sounds like a story and a half.
That has happened before. I was so furious. I was not the pregnant lender, but there was another one, and we literally walked on the site with demolished asbestos in the ground, and the developer did not say a word. Needless to say, we found out, and we did not lend to this person.
No, I can imagine.
But asbestos is not a big issue because it's just a cost and money. There's a saying, if it's cost and money, it's just expense, it's not a problem. But when it comes to contaminated land, some lenders have very strict rules. They just don't want to deal with any contaminated sites. But contamination comes in different shapes and forms. You can have a simple cases of contamination, and the remedy is you just remove 6 inches of soil, dispose it safely, replace it with a fresh soil, and off you go, you're done.
And that's normally on old fuel stations and things like that, isn't it? Where oil's
that's a different story. That's a more severe case. So if it's a simple case, all you need is to budget for it and allow time within your construction program to remedy this. But you still have to disclose it to the lenders, because some of them will say, no, we don't want to do it no matter what, we're just uncomfortable. And some of them will just accept it as a matter of business, because lots of sites are contaminated and it's easy to remedy. As long as you budget for it, you're good to go.
And in terms of Japanese knotweed, that really is just treatment plan, and then presumably you're going to want to see some
warranty.
Evidence that, for example, it could be refinanced. So you want to see some evidence that if that treatment plan's in place and it takes place and everything else.
It's treatment plan, and quite often it's multiple treatment sessions, and then there is warranty. And they now got so it's so well established that you can have warranty for 5 to 10 years. You pay for it, but the cost is not significant. Now, what we need to be aware of is that inside of London, it's a lot more common and a lot more acceptable. It also depends how far it is from the building, albeit it spreads so fast, it doesn't really matter how far it is from the building. But in London, it's a lot more acceptable, and people do tend to buy properties and mortgage properties with Japanese knotweed, or previous presence of Japanese knotweed. While outside of London, there is so much choice that and people are less familiar with Japanese knotweed, and they're scared of it, and sometimes that can actually affect especially buyers' desire to buy those sites, because they will be thinking, well, I don't want to buy it, and then I'll have to deal with it, and I'll have to call in a warranty. I don't want to deal with warranties. I don't want to deal with anyone else. I just want to buy a clean site and clean house. So yes, you're right. It's the location is key. Treatment plan is a warranty is the second point, and the third point is who is going to buy it. Will it put off some buyers, and will there be a mortgage provider that will happily fund it? And high street banks do fund sites with a treatment plant and a warranty.
Yeah, and I think most challengers do now as well. So I think, like you said, it's becoming so much more commonplace now for lenders that actually it's probably going to get to a point where many of them aren't going to be that bothered about it at all. I think as long as that treatment plan and warranty is in place.
Agree. But disclose it early again. If the lender has very strict policy, no Japanese knotweed, you want to tell them early, they will say no, and you walk away and you go for the next lender. You don't waste your time trying to process a transaction to find out that there is Japanese knotweed later on.
That's it. It's wasted money that just absolutely don't need to waste. So, in terms of just continuing with kind of these issues that you may face, so let's talk about party walls sort of quickly. So, at what stage realistically are you sort of thinking that developers should start a party wall awards process?
Party wall award is a tricky one because it's the distance from the bottom of your foundation to the bottom of your foundation of the neighbor, and they're hidden. And you can't see it, and especially the neighbor's one. You don't know how deep his foundation is. So anything within 3 meters, you have to have party wall awards. So that's easy. But if it's 6 meters, then it comes to the foundation in the 45 degrees angle. I don't know if you have seen the graphs, how this whole thing works. And the calculation goes from the bottom of your foundation, 45 degrees to the neighbor. If it crosses the neighbor's foundation, you have to have party walls. And 6 meters, it's quite a long distance. It's quite a gap. So with the 6 meters, you think, well, I don't actually know if I need one. So you do need to get advice, first of all. With 3 meters and less, you probably do need one. So you need to start the process. Party walls, the beauty of it is, the beauty and the beast. The beast is you have to do it. It's legal requirement. You cannot build without having party wall awards in place. Yeah. And knocking on your neighbor's doors, having a cup of tea and saying, oh, by the way, I'm going to build within 2 meters of your property. Are you okay with that? That's not going to that's not going to work. So you have to have it. But the beauty is your neighbors cannot refuse party wall awards. Yeah. They can refuse to comment, they can refuse to engage. But if they do that, that's almost in your favor because that gives you the right to appoint the party wall surveyor by yourself. All you need to do, you need to follow the process. So you submit your notices, you wait 14 days, they don't respond, and then you submit another notice, and then you wait another 14 days, and then you can submit, and then you can follow the process and appoint the party wall award surveyor to put the framework in place for both sides. The funny thing is, party wall award surveyor, I'm sure you know it, acts for the wall. They don't act for the neighbor, they don't act for you, they act for the wall, they protect the wall.
Yeah.
And that's the idea. So you have to do this before you start. And it doesn't matter whether the neighbors cooperate or not, you just have to submit the notices. And the earlier you do it, the sooner you will finish the process before your commencement date.
And how many developers would you say actually realize that is a thing that they need to do? Diplomatically low.
If they have a good advisors by their side, apropos brokers who understand the topic, they will be advised to do so. If they don't, the chances are the lenders will tell them to do so. Because our monitoring surveyors, the independent monitoring surveyors, will pick up on party wall awards and they will tell, even though they're not specialists, but they will measure the distance, they will have an idea of depth of foundation, and they will tell the lender, by the way, party wall awards are needed here. So the lender will start hammering the borrower to get party wall awards. But you don't want to wait too long and too close to completion. You want to start it early so you finish it early.
Yeah, and things you don't want to have to wait 28 days. I mean, it's a 28 delay.
It's even longer. There's several stages where you submit the notices, and if they don't respond, you're allowed to submit the next notice. And if they don't respond, it's longer than 28 days actually. So the sooner the better.
A chunky old delay potentially, and the feasibility report as well potentially, if they go and recruit their own independent, should flag it up as well. Yes. In terms of right of light indemnity, let's talk about that.
Oh, that's a brilliant one. So
that'll be our last one for this episode. I think our last curveball.
Right of light is it's actually a really good one and a really scary one, because so many people confuse rights of light with daylight and sunlight.
Yeah.
So daylight and sunlight are included in your planning application, and it sounds similar. So when you ask, and the amount of times I put, can you clarify or confirm whether there's any right of light issue with the project? The amount of time I will get the response, oh, we got right of light and sunlight reports. We got a daylight and sunlight report within our planning application. It's all got approved. It's all fine. And then you take a breath in, you take the breath out, and you call the broker and you explain to them that right of light is a different infringement and it's a different assessment to the planning one. And if you have right of light infringement on your neighbors, they can sit quietly and wait for you to build your project up, and they can go to court and they get injunction for you to take that project down. They do not have to accept a compensation for that. And that's the scariest thing. You cannot buy somebody else's right of light. The other scary thing is You cannot knock on the door and say, why don't I pay you £50,000 for my right to block your light? Because if they say no, you cannot get indemnity insurance for the right of light infringement anymore, because indemnity insurance providers will not indemnify you if you have had conversations with neighbors.
Yeah, it's that acknowledgement, isn't it? Same with any indemnity policy. If you go and speak to the council or anything like that, it gets rid of your ability
Precisely.
at all to do an indemnity.
And then it brings you to the lending side. Lenders will not lend on a project that has infringement over the neighboring light and it's not insured. So the only way to deal with, if there's any risk of right of light infringement, you get the survey done early. That takes about 3 weeks. And if there's anything else at all there, because the neighbors can prevent you from developing or can force you to take the building down, you just go and get indemnity insurance in place.
And that indemnity essentially covers if there's ever any loss, essentially financially, from then having to take it down, isn't it? It's that insurance essentially of that. And the indemnity part is essentially the no knowledge part, isn't it? You're indemnifying against no knowledge of this happening, sort of thing. And it's if you had that knowledge, i.e. going and knocking on the neighbour's door and offering 50 grand, that's what then gets rid of that ability to insure.
You have the knowledge that you are infringing, and you provide the survey to the indemnity insurance providers, but you need to disclose that you haven't discussed it with anyone, of the neighbors. And this is where we when I used to train about right of light, I would say to the guys, when you walk on site, do not point at neighbors' windows and do not ask the question about right of light. Do not shout, do not speak loudly about right of light. Have this conversation in private, very quietly. Are you going to block somebody else's light? And the funny thing is, it's not just the bedrooms and the living room windows, it's any windows. So anything facing your development, if you're building to block it, you will have right of light issue. Have the survey done, have the indemnity insurance in place before you complete. Lenders will not complete without it.
Amazing. And that brings us to the end of part 1. Thank you very much. And thank you very much to everyone for listening.
Thank you.